Welcome to Core Finance, and I'm joined by Ben Kumar, who is an investment manager at Seven Investment Management. How are you today, Ben?
Very well, Zach. You?
I'm doing okay. I'm still trying to mull over the markets. Second half of the year, days are getting shorter already. What's the strategy as far as an investment manager is concerned at the moment?
Caution, I think. Be very wary of people telling you that this has longer to run. I think for the minute, lots of people who reluctantly were invested, probably through the start of the year, they've done all right out of it. You've made maybe a year's return. If you've been buying most equities, you've made your year's return. Do you want to push it a bit more? Do you want to believe that tech bubble can go up a bit more? Do you think that the markets are so resilient now to shocks that no downturn ever comes? It seems a bit, to me, like you want to be taking risk off the table.
But that's the problem at the moment. That's what everybody's saying. Everybody's saying that actually there's too much risk. Even Deutsche Bank are obviously experts at managing and controlling risk. Have said that the markets look in a precarious state. Various other people have been wheeled out. Jim Rogers. They're all trying to pin the tail on that bearish donkey for the end of the year. That's not a horrible concept. And so basically, we're still climbing that wall of worry, aren't we?
Yeah, I think we are. And you know what? It can go on for a lot longer than people think, right? Everyone always says, bull markets don't die of old age. There's no time limit on this. It's when noises are made in the macroeconomy that start scaring investors. And I think, at least in the short term, I think the ECB and the Bank of Japan are one of those noises that people are looking for. People are worrying about tapering. People are worried about the ECB stopping pumping money in. The Fed has already, said that actually we're going to look at how we reduce the number of assets on our balance sheet. There are noises out there that investors are starting to take notice of. Now, I don't think we're seeing, I'm not saying, it's 2007 all over again, this is the end of it. I'm just saying that, markets look a little bit high and you might want to see some evidence. Places we do like are really niche places. Frontier markets. Frontier markets basically don't really care what's going on in the wider world. They sort of take whatever monetary policy they're given and try and do the best they can. Places like Vietnam, places like Pakistan, even some of the smaller emerging ones now, like Laos, Cambodia, they're all in the middle, in the heartland of Asia, where things are kind of on the ground, going pretty well.
So that's where, somebody like Seven, that you're doing the heavy lifting for people because, if I want to buy something on the Laos Stock Exchange, because I think it's a great place, it's rather fiddly, but then you just have a big basket. You can just, it's like playing a piano, just hit that note. It's very easy for you to switch around. You have the basket of assets in different places.
Yeah, exactly right. So, we have been doing a lot of work recently on increasing our frontier markets exposure. It might mean finding an active manager who's out there literally on the ground picking those stocks, or it might be something a little bit more passive. But the point is, if we believe that frontier markets offer you better value, better risk-reward trade-off, we'll move those assets for you. Now, I think there are other niche areas of the market where things still do look good. Emerging market dollar debt is really under-owned and underappreciated. The reason it's under-owned and underappreciated is because it's countries like Gabon or Yemen issuing dollar-denominated debt. They're not going to default on it, though, because if you default on your debt, you end up in the situation Venezuela's in, and that's a pretty stark warning to people. So again, there you get paid 5% a year. That's not too bad in dollar terms. So little niche areas are where there are still pockets of interest, but trying to avoid the S&P is uppermost in our minds.
But is it the case that, even in the worst looking scenario, let's say the Fed started raising rates here, there's always something for you as an investment manager, there's always a sunny place that you can park people's money because you've got the whole world at your fingertips, let's say.
Yeah, so multi-asset investing, you should always and never be apologising. You're always going to get something wrong, right? You might be invested in gold and it's not doing too well at the moment. But then you should also be getting something right. Like I say, the frontier markets is a great example. So you need to be, from our point of view, diversified for investors for the long term. And the world we're in at the moment seems to be one of those periods where diversification is starting to get some attention again. People are saying, I am worried about the FANG stocks. I am worried about how excited everyone's getting about the technology bubble or not in the US. And I do think I should be taking a little bit of risk somewhere else. Now, the interesting thing is when you get Americans starting to do it. And that takes a really long time to get into their heads that actually, the market might be overvalued. But when the US retail investor starts looking abroad for opportunities, then those foreign markets really start flying.
Ben Kumar, Investment Management at 7 Investment Management, thanks for coming in today.